Day.
Joining us now, Jeremy Nelson, a partner at Element Wealth. Jeremy, thanks for coming in, the Element Wealth Studios.
Always appreciate the invite. Thank you.
Yeah, man. So we thought it made sense to have you in to help us understand what in the heck is going on with these extremely volatile markets. A big downturn the last several days. Looks like we're getting a little bit of a bear bounce maybe today. I'm not sure I'd call it a rally. Yeah. But maybe a kind of a temporary sort of bounce in anticipation later on this afternoon of the Fed telling us what they're going to do with respect to the benchmark interest rate. Most analyst economists are predicting 75 basis points, 3/4 of a point. Wasn't too long ago, we talked about this on the program earlier. Fed Chairman Jerome Powell said we're taking 75 basis points off the table, and we got a rally after that, right?
Yeah, so last time I was in, we talked about the volatility index, all those sorts of things. We talked about, the Fed was going to go 50, and they took 75 off the table for the last hike, right? But they didn't take it off the table for this hike.
Okay.
And so, look, they have to. And I think that the market will actually respond well to it because what we saw over the last week or so here was rates jumped astronomically.
Yeah.
Right. So, we'd pushed up above 3% on the 10-year Treasury. Then we backed down to about 2.7% on the 10-year Treasury. And then we rocketed up to around 3.5%. And we're trading, 340 today or so.
Yeah, down a little bit.
And so what you saw was this massive, 80 basis point jump in the 10-year because the inflation numbers aren't coming down.
Yeah.
And essentially what that's doing is it's pushing the Fed into a corner where they are now going to have to shoot down inflation and worry about growth later, right? They've got to get these inflation numbers under control because they're peaking, but they haven't quite peaked, right? And we really need to see those numbers begin to turn down in order to get some confidence back in the market.
Don't you think that the market was looking for some sign that inflation was at a minimum stabilizing, moderating, and we didn't get that, and that sent us into a tailspin? Is that
exactly? So last time I was in, right, it was on a Friday, and we had a little bit of that dead cat bounce.
Yeah.
And we kind of said, look, this is not the end of it, and we actually pushed slightly to new lows, at the beginning of this week. So the market needs to see the inflation numbers come in, and the Fed has to prioritize. Now, remember this, though. The Fed's job isn't to keep the market up.
right?
And we are in this predicament because the Fed tried to keep the market up.
Right.
So, but the Fed's got to get the inflation under control because it's affecting Americans. I mean, and at the end of the day, when you look at the price of gas, the price of everything, the shortages in food, baby formula, whatever, across the board, consistently, there's all these things we're having shortages of that are literally affecting the lives of Americans.
Yeah.
And it's time for the Fed to just kind of put their foot on the gas, raise the rates, get up to where they need to be, bring these inflation numbers down because that's the number one thing right now.
Yeah. So there are concerns, of course, and the Fed is trying to, as you know, thread this needle. What can we do to cool inflation without tipping the economy into a recession? That's the so-called soft landing, which would mean we are able to moderate inflation and we don't go into a recession. Honestly, Jeremy, my bigger concern is that we get this 3/4 of a point rate hike today and we don't see any change in the inflation.
It's going to take time, right? So just because the Fed moves rates today doesn't mean that tomorrow all of a sudden inflation is going to come down, right? There's going to be a lag effect here. The actions that they're taking today are what's going to begin to slow things down in a couple of months.
Yeah.
And so, why we're seeing the numbers at the level we're seeing them at right now from an inflationary perspective is because the Fed waited way too long.
Yeah.
The inflation train had left the station, and they hadn't done anything. And now they're having to play catch-up.
Well, the Fed chairman himself is on record as saying we believe it's transitory. We got the Secretary of the Treasury saying she believed it's transitory. And so that was the talking point. That was seemed like the widely held view of those in charge.
I think that, and I agree to a certain degree that some of it is transitory, but it's not completely transitory.
Okay.
When you run negative real interest rates, right? Yeah. So when you look at the 10-year Treasury and you look at what inflation is, and when the 10-year Treasury is predominantly below the rate of inflation for 14 years, you're going to get inflation at some point.
Makes sense. Yeah, makes sense. Because we had the Treasury down in the 1%, below 1% range for a while, and we had inflation in the 2% or so range. Yeah. And so, all right, so some economists would say until we get the Fed funds rate, the benchmark rate up somewhere around the CPI, we're not going to see a lot of influence on pricing.
So I think there's a little nuance to that. I think that they're going to converge at some point, right? Okay. The inflation numbers are going to come down. Because remember, your inflation numbers are a year-over-year number.
Yeah.
And so you're comparing to 12 months ago.
Right.
So naturally, as we get later into this year, and the inflation numbers were higher at the end of last year, and we're comparing to those higher numbers, then we're going to see a decline in the inflation rate. So you're going to get this decline in the inflation rate as rates are going up. They will converge at some point.
Okay.
You know, where that is it, I mean, we talked last time, we kind of see 3.25 Fed funds rate by the summer of next year.
Okay.
Might be a little higher now. Right, because it is taking longer for the inflation to peak. It hasn't peaked. It's probably going to be later this summer when it finally does.
Yeah.
So we'll see.
Well, so where are we now? 1% Fed funds rate?
Just above you.
Yeah. Okay. So we get 3/4 today. And last time we did that, I looked it up, 94, I believe.
Yeah.
Right.
It's been since the mid-'90s since we had a hike this big.
And you know, I don't know how much it is related, but that was the same year that Orange County, California, filed for bankruptcy.
Really?
Yeah. The county filed for bankruptcy. Sure did. In the wake of the 3/4 point hike. I don't know if it was related. They may have had a lot of debt. I don't know.
They must have had a lot of variable rate debt.
Variable rate debt's what I thought as well. I didn't go dig further into it. I just thought that was an interesting timing coincidence there. But so as we know, we've been talking about on the program, when you get the interest rates up, it consumers, of course, it affects. But the bigger issue to me is in the commercial segment. The cost of capital and the cost of money rises, which tends to reduce their inclination to go make purchases that they finance through debt. And that has an effect throughout. That just ripples through the whole economy. It's just less economic activity.
Well, and it ultimately affects valuations as well.
Yeah,
right?
True.
And so I know, over the last 24 months since COVID, the market went a little bit wild with some of the tech stocks and, classically trained people like me with MBAs that do discounted cash flow analysis. We weren't very popular. We were losers. But at the end of the day, if you get into how you value companies, the risk-free rate is a major input. And as interest rates go up, then the cost of capital goes up and valuations on stocks come down.
Right.
But if you look at, say the S&P 500 now, it was trading at 30, 34 times earnings 12 months ago. Now you're trading at 20 times earnings.
Yeah.
So stocks today are trading probably pretty close to fair value.
Okay.
Right? So we think that the majority of the damage in stocks is done. Could it get a little worse? Yeah. Because most of the time when things go up, they overshoot on the upside, and when they go down, they overshoot on the downside.
Yeah.
But today I think stocks generally are probably pretty fairly valued based on the profit that stocks are generating. So, we've kind of got a little bit of an eye on some things selectively that we think are starting to look pretty attractive.
I haven't seen anybody, however, just declare bottom. Have you?
No, because you just haven't hit the conditions for a bottom.
Okay.
Right? So we've got some oversold indicators that we're following, and it just never quite got there yet.
Yeah. You got to go? You can hang around.
I can hang around.
All right, we got another segment coming back with Jeremy Nelson, a partner at Element Wealth. Stay with us. Be in the Element Wealth studios, Jeremy Nelson, partner at Element Wealth. All right, so Jeremy, folks are saying that, and I apologize for this, we're talking a bit over their heads and some stuff, and we're not trying to. I can assure you that. But this is a valid question. Folks are looking at their 401ks and they're stressed. They're worried. We got listeners who have said, "Gosh, I was thinking about retiring, but due to the losses I've experienced, I can't. I got to keep working and got to get my nest egg built back up." It's been a lot of value destruction as a result of the markets plummeting and plunging. So, what do you say to somebody that has experienced a significant downturn in the value of their portfolio, their nest egg? They're approaching retirement, but they don't feel like they have enough saved up, put away to sustain them. What do you say to them, given the present conditions?
So the first thing you really have to do is an inventory of what you've got, right? You have to have a financial plan.
Yeah.
I can't tell you how many people come into our office and say, "I'm retiring, what can we do?" And I'm like, well, we really should have had this conversation a few years ago to figure out and make sure that you had enough. And there's been times where I've told people, based on what you're telling me you're going to spend, there's not enough money here. You do need to continue to work. So first and foremost, you want to do an inventory and you want to do a plan. What's happening in the stock market right now, that portion of your portfolio, this is not abnormal, right? A 20% correction in the market actually happens typically every 3 years or so. All right, we skirted up against, we had it during COVID. We skirted up against it in 2011. Obviously, the financial crisis. So it is not that abnormal for the markets to correct 20%. What is abnormal right now is what's going on in the bond markets. So as we get closer to retirement, a lot of people who are going to be looking at their 401ks, they're going to have money in a target date fund, right? We've all seen these target date funds in our portfolios. And a large portion of, the 2020 fund, say, is going to be in bonds. Well, bonds are down with interest rates being up.
Yeah.
Those bonds, though, ultimately will mature, right? And then they will reinvest at higher interest rates.
Yeah.
So I think for anybody that's going through this right now, you've kind of got to do the exercise of really understanding, what do I own? How long is it going to take to recover? How much of the decline is from the rise in interest rates, which ultimately means in the future I'm going to make more interest, so that is good, versus how much is in stocks. And then selectively, right, do I own high-quality stuff that I can feel comfortable with? Yeah. Or do I own some garbage that I got to worry about?
Yeah. Because strong companies with strong balance sheets, we're seeing this trouncing of big tech, for example, which includes stalwarts such as Apple and Microsoft, very valuable companies, very profitable companies, but they're still getting pounded. And so, all the all the analysts that I've seen still say, gee, we're still buying that stuff on the way down. We're not just going all in, but we still see those as long-term good investments. They're still going to be around. They're still going to be profitable. And honestly, I believe if they're not, it doesn't matter. Nothing else is going to work in our economy.
Well, exactly, right. And so when you look under the hood of these companies, like you referenced and some others, the Googles, and we won't give security recommendations on the radio, but if you go under the hood and you look at the public data that's out there on Google and Facebook and Amazon and Apple, and you look at the consistency of their revenue and profit growth, right? And you look at their, the valuations of companies now, what they're trading at today versus what they were trading at before, I understand why these analysts that get on CNBC are saying, hey, look, we're continuing to buy these types of companies because they're trading at market multiples now, but they're growing at faster rates than the multiples.
So they're on sale, essentially. Yeah. It doesn't align, they're on sale. So question, how will interest rates affect the housing market? We got mortgage rates yesterday being quoted 6.2, 6.3 for a conventional 30-year.
I see this as a major, major thing. We've talked about this for a while. So About 6 months ago, you could get a 30-year mortgage at 3%. So if you could afford $3,000 in principal and interest, you could buy about a $700,000 house. Today, that $3,000 buys you a roughly $511,000 mortgage.
Right.
So that's a $190,000 gap here that we're talking about. Now, it's going to take time. There's going to be a lag effect, right? But eventually, when everybody can afford less house, it has to affect the housing market.
Yeah.
It's inevitable.
Don't you have to also be concerned about this dramatic run-up in housing prices we saw over the last 12, 14, 18 months as a result of demand, supply, and people cashing out, having made a lot of money in the market? You saw a lot of that.
Yeah.
A lot of funny money as well. They're going out, and we had this and a lot of just folks just hunkered down and not doing anything. And now they get out, and that caused the prices. It's just demand-supply dynamic. Are they at risk, though, when they bought at the market high? They may be locked into a really low-rate mortgage, and so from an affordability perspective, they're protected, but the amount of money they invested in that asset might be at risk.
Yeah, so housing is interesting. I think that, look, a house is a place to live, right? And I know a lot of people look at their house as an investment.
Yeah.
But a house at the end of the day is a place to live. So as long as you're not selling or being, your job's not transferring you, you're not going to get hurt, until you sell.
I agree.
So as long as you've got the way to offset your risk there is look at what a regular mortgage would be at today's rates, look at what you're paying, save the extra into an investment account, and that'll offset any decline that you would have in the price of the house.
Yeah, so here's a question. Not sure what you think about this. Just Kirk from Columbus. Ask your guest how he feels about EV charging station stocks. Does he really think that there's going to experience a big increase in as an investment? I know you don't want to get into recommending particular issues, but...
So I believe that there are a lot of really, really speculative areas to the market. And EV charging stations would be one of them. I think that stocks like that are like going to the casino, right? These companies do not make money.
Right.
And there is a major risk that a lot of them will ultimately go bankrupt. And so, what I always try to tell people is it's okay to have some play money, but it's got to be the money you're willing to lose. It can't be your core retirement money.
Yep. I want to say Blink is one of the ones. I saw the CEO yesterday on the Business Channel talking about it. And, of course, this is another situation where this is ideological. So you got government pouring gazillions of dollars, right? We're going to build 500,000 charging stations. That was appropriated and enacted in the 1.9 or 1.2 trillion bipartisan infrastructure act, and that included 500,000 charging stations. So these guys are going to benefit from that. The CEO was talking about that. But you're right, still not making any money. This is kind of like the dot-com era. Who's going to prevail? Who's going to be standing when all's said and done?
I think that if you go back, and I think that's a perfect analogy because we've talked about this a lot with clients. If you go back and look at the dot-com bubble, there were winners and there were a lot of losers. If you waited until the dust settled and just picked up the ones that didn't go bankrupt, you did really well.
That's right.
Right? So I don't think that people need to be rushing in here today to try to figure out who the winners and losers are. I think there's going to be plenty of time for the dust to settle on a lot of this, EV charging stations or different tech stocks and things that were really hot last year that are now just getting absolutely trashed.
Yeah, I think you're right about that as well. But this is another situation where, government is influencing because they're putting in place policies that hurt one industry and benefit another.
Yeah.
At the end of the day, they're picking the winners and losers rather than the market doing it.
But what we've seen about that specific kind of industry is they still haven't been able to generate profit, even with subsidies.
Right. Haven't made a dime. Yeah.
And so I just think for us who are dealing with other people's money, right? So we tend to be a little more conservative because I don't want to wake up and look at someone and say, sorry, you can't retire because of what we did.
Yeah.
For us, we're just a little more conservative on it. Yeah. And I think that once we'll get to a point where the market will let us know when the dust is settled, there's going to be some bankruptcies. and picking up the winners at that point will probably make sense.
Yeah, that makes sense. But it does feel like we're in kind of the late 90s of the dot-com stuff, and everybody's trying to get something out there, some offering, and who was left standing after all was said and done is who ended up making money.
Yep, so exactly.
Appreciate you coming in, Jeremy. Great discussion. Thanks for your insight.
Appreciate it. Thank you.
Man.
All right.
Jeremy Nelson, partner with Element Wealth Studios. We'll be right back in the Element Wealth. I should say Element Wealth. We're in the Element Wealth Studios. We'll be right back.